Boil down SPACs and private equity to their most simplistic definitions, they sound pretty familiar. Raise capital from outside investors to fund deals. Of course, SPACs typically take companies private, or private companies public, rather, and buyouts often take public companies private, among other key differences. But this year's SPAC frenzy, which we've been covering this week in our segment called SPAC in Action, is shifting attention to the private equity model. Here's BlackRock's Larry Fink, who said last month that the SPAC frenzy could put pressure on the buyout industry.
In many cases, I think SPACs could replace many private equity platforms because they could be another avenue for organizations or subsidiaries of organizations to be spun out. So if SPACs continue to grow in importance, I do believe it's going to be pressure on some private equity because you're going to see more money moving into these type of organizations.
Now, the concern among some is that the excess of new capital from SPACs will be chasing the same supply of deals, driving up valuations. Sources that advise on these deals have told me that competition is fierce to find targets right now, and in some cases, that's causing hasty due diligence and a willingness to pay up. But rather than sit out on the sidelines, traditional private equity is just getting into the SPAC game in droves. Apollo Global, TPG, Cerberus, Oaktree, and Fortress have all raised SPACs this year, guys.
Leslie, I wonder what, and I guess we're probably not far enough into this as a sort of industry, as it were, or subset of an industry to have the clear data on it. But if you have a successful investment over 5 years and it doubles in value, what the difference in fees to the end investor would be having gone via a SPAC versus a sort of traditional 2 and 20 type private equity carried interest model?
Yeah, that's a really good question about the fees. So the way that the SPAC model currently works, and we talked about this yesterday, is that it has a 20% promote, which isn't too dissimilar from the 20% incentive fee that you tend to see in a traditional private equity model. Now, of course, there are differences in the amount of a management fee, for example, that you'd have with a SPAC. And different SPACs from private equity firms operate in different places. Some actually operate in the portfolio as a whole. Some operate outside of it. So the fee structure is very complicated. And as this starts to become an increasing trend, some LPs are looking at, potential conflicts of interest that might arise from the increase in SPACs from their GPs that continue kind of to participate in this trend.
Shepard Smith here. Thanks for watching CNBC on YouTube.